Hey everyone, it's Andrew here. So I've just finished watching a really good Google talk with Chuck Akre called Trying to Solve the Investment Puzzle that is definitely a valuable watch. I thought I would share the takeaways from Chuck that I think are unique and that we could all think about with our own investing journey. Now quickly, before I start, I recommend Interactive Brokers as the best and safest of the brokers to use if you're starting investing. There's a link in the description if you want to take a demo account for a spin and see how it all works. I have demo videos here on the channel as well. I also have an e-magazine that I put out once a month where I share my thoughts on the market. Plus I have my watch list there and I have intrinsic values of all of those businesses on the watch list. There's a link in the description as well. And if you do get some value out of this video, please give the video a like and subscribe. It definitely helps me out. Now regarding Chuck Akre, he is a phenomenal investor with a great track record, smashing the S&P 500 by almost 10% over multiple decades now. Anything above the index is just really impressive, but crushing the index by so much puts him in really rare air. And the coolest thing I think is that Chuck never just started as some finance genius. He started, in his words, as a know-nothing. He's actually an English major. Not the same credentials as many finance guys like Bill Ackman or anyone like that. But this, I think personally, is a big advantage. I think if you come from some economic school and go work for a money manager or something like that, I think people can get like a little bit jaded. The creative, rational approach can sometimes get lost in all the numbers and the analysis and just following what the previous person was doing. The person, your boss, like I think you get manipulated by your boss to think the same way as your boss. So coming from a background that's not in finance, I think is really advantageous. And I actually think Bill Ackman is brilliant at being able to not fall down this trap. But look, so many people do. I've been to conferences before where like analysts who were academically really smart, but they just said the stupidest things. They were like illogical things about investing that made no sense. And I think they just learned it from their bosses. So my first big takeaway here from Chuck is that it's advantageous to teach yourself and think independently. Economics degrees are more likely to be harmful than valuable. This is my experience and my takeaway. Chuck Akre definitely didn't say this, but this is what I think. Anyway, now to choosing investments. Now, what makes a great investment, according to Chuck Akre, is he talks about this three-legged stool metaphor. A three-legged stool needs all three legs to stand, and if one of those legs is broken, the stool doesn't work. Anyway, here are the three legs. Leg number one is the rate of return. So how good is the company at getting a return from the money that it generates? This is calculated by the return on owner's earnings. Return on equity, or ROE, is a good place to start as you can screen for this, like in a stock screener, but you have to dig a little deeper sometimes and make sure that the cash from operations minus maintenance capital expenditures is growing. Look, this was nice to hear because it's exactly how I attempt to value businesses with my intrinsic value calculator. So that's operating cash flow minus maintenance capital expenditures growing at a good rate is a good first filter. Now couple that with making sure that the equity of the business is growing at a similar rate and that the shares of the business aren't being diluted. Well, this is my interpretation of a good rate of return. As you see by the clock, there's been a bit of a delay, but I'm back. Okay, so what is a good rate? Well, I think that 20% plus is a good rate of return, but it's actually relative. If 5 businesses are all competing in the same industry, for example, and 4 of the 5 are getting 30% ROE, and a business that I'm looking at gets 20% ROE, then over time, as the market gets harder and harder to play in, the business growing at 20% ROE is going to fall behind because the competition is better. So you've got to take that into account as well. But if you find a business that is returning exceptional rates of return, you still need to figure out what makes this business so special. See, maybe it is just like the industry is exploding. And that second leg of the stool is the people who run the business. So Chuck Akre said, they need to have demonstrated a record of being killers at operating their business. In addition to that is that they treat us, the shareholders, as partners, even though they don't know us. Now, this is the leg of the stool that often I don't pay enough attention to. And that is my fault and a lesson I'm learning over time. I want the management team to have skill and integrity. Now, one way to filter out companies that don't have this leg of the stool is to see if the salaries of the management are more important than the shares that they own. So imagine if you are getting paid $1 million a year and you have $1 million of shares in the business as well. well, you feel pretty safe that you have your salary, and if the share price goes down, it doesn't really hurt you that much. But if you're like, say, Warren Buffett, where he pays himself like a couple of $100,000 a year, but has like $80 billion in stock in the business, well, if he poorly manages the business, that is devastating to his net worth. And I would much prefer to align myself with these highly incentivized managers because we are then on the same team. Now, the third and final leg of the stool is the reinvestment opportunity. This is where it gets a bit tricky because the future is hard to figure out. But essentially, we are looking for businesses that have ample opportunity to reinvest the money they make into more things to continue to get that high rate of return. Now, Monish Pabrai describes Tencent in a really fantastic way regarding their reinvestment runway. Pony Ma at Tencent, he has this army of software engineers that build and create new products and have new services for WeChat and their other software services. This part of the business returns huge returns historically. I think it's like 50% plus per annum. It's incredible. But there is just only so many good quality software engineers that are good enough to hire each year, and only so many projects these engineers can actually work on. So the next thing is to reinvest in other businesses that they can help grow, like JD.com and Pinduoduo and VIP Shop. If they do this well, they might be able to get 20% returns, and this runway hasn't been exhausted yet and should be able to continue for decades as new companies are needing funding all the time. So Tencent uses all of its operating cash flow minus maintenance capex and has ample things to reinvest back into at high rates of return. And that's what this leg of the stool is all about. So we have leg one, which is that good rate of return. We have the second leg is the great management, and the third leg is ample reinvestment opportunity. Now we're taking a look at Akre Capital Management, which is the fund that Chuck Akre started, but he's actually retired now. But the three-legged stool philosophy still holds true in the portfolio, and that's what the current people who are running the fund are still trying to achieve. So I still think it's a really good hunting ground for interesting companies that maybe you haven't looked at before, because they're going to have these three legs of the stool in their opinion. So look, I think this is fantastic hunting. All right, MasterCard, Moody's, American Tower Corp. Now, MasterCard, we got MasterCard and Visa here as number one and number four. He talks about these in the Google presentation that he gave about how they have these huge return on equity numbers. Moody's is a company that I actually haven't studied a lot before, but I know Guy Spear has talked a lot about Moody's before. American Tower Corp is the business that Chuck Akre talks about as his big 100 bagger, and this is a business that he was he invested in the early 2000s and has just been a huge return, and a huge reason why he's had such good returns in his portfolio is American Tower Corp. Constellation Software, another amazing business, probably one of my favorite businesses of all time. Constellation Software, that definitely has the three legs of the stool. And you can see a little bit further down here, I think it says Topicus. Yeah, Topicus is a spin-off of Constellation Software. Amazing companies here. O'Reilly Automotive, Adobe, CoStar Group is an amazing company with a huge moat in the real estate business. There's Salesforce here, Danaher Corp, RDN, wow, okay, the Berkshire Hathaway. There's a company here called ThreadUp Inc. Now, I had a little look at ThreadUp Inc. and I couldn't quite work this one out, because maybe someone in my audience here can tell me more about why ThreadUp Inc. has these three legs of the stool, because I think that ThreadUp it's essentially a business that you send in like your old clothes and stuff like that, and they recycle and try to sell them off, or they try to sell them to other people, like secondhand clothes essentially. And I don't get this business. I feel like no one's making any money here. But anyway, I don't know if you have any insight into ThreadUp Inc. I'd love to hear it. But there you go. That's a look at the portfolio as it stands today. So I like how he makes investing sound achievable for all of us. I hope you've enjoyed this video. Don't forget to like and subscribe before you go, and I will see you in the next video.